If we take a moment to look back at the stock market over the long term, we'll see some interesting data. Back in 2008, we witnessed some of the biggest returns in history. Stocks have gone up almost 500%, bringing the Russell 2000 index above 2,000 points. Most of those gains have occurred in just the previous year, where we've seen how it doubled from 1,000 points. This has made a lot of investors wonder, what is the best way to invest with huge stock prices? As usual, we all like to base our decisions from the advice of experts. For this video, we'll take our move from Warren Buffett. Hey, welcome to Stock Market Mate. Today, we'll look into how Warren Buffett invests when stock prices are overvalued. Before we get into it, make sure to subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. It's important to be able to recognize the signs that a stock is overvalued. The sooner you become aware of an overvalued stock, the easier you can avoid losing money on an investment. It's imperative to carefully research every stock in which you're considering investing and to know the indicators of inflated valuations so that you can save time, effort, and money. So how can you tell if a stock is overvalued? First of all, overvalued stocks trade at a market price that is significantly higher than their fair value as a result of increasing investor confidence or biased consensus estimates. A stock is thought to be overvalued when its current price doesn't line up with its PE ratio or earnings forecast. If a stock's price is 50 times earnings, for instance, it's likely to be overvalued compared to one that's trading for 10 times earnings. Many types of useful signals may show that a stock deserves a closer look. It's helpful to start with a review of the annual report, 10K filing, balance sheet, income statement, and other statements. These will give you a feel for the way the firm works, before you dig deeper into numbers. Now that we've cleared that up, let's talk about Buffett's strategies on how to invest when stocks are overvalued. First off, find stocks that are undervalued. Warren Buffett's main strategy in investing in overpriced stocks is to find stocks that are undervalued. Be on the lookout for stocks that are cheaper than their intrinsic value. However, at the same time, also remember to focus on quality stocks for investment and pick the ones that possess the potential to generate value. But to be honest, in today's market, those deals are incredibly rare. According to industry experts, Buffett is focusing on increasing his cash pile, and this is why he has been able to raise his personal wealth exponentially from $45 billion in 2008 to $140 billion in 2021. According to Wikipedia, Warren is considered as one of the most successful investors across the globe and has a net worth of over $100.9 billion as of now. This just means that he can buy stocks or businesses that he wants. However, Buffett purposely chooses to wait by allowing his money to build up until an attractive business comes along. To take a good look at how Buffett's strategy works, let's look back at what happened in 2008. In 2006 to 2007, the market was extremely expensive and Buffett was having a hard time looking for deals, so he kept his money in short-term treasury bonds, which is literally the same as cash. In 2007, Warren Buffett, together with Berkshire Hathaway, had $45 billion of cash ready to deploy. Back then, that was a very significant amount of money for his investing business. Then we all know the great financial crisis hit and stocks plummeted down. This was Buffett's cue to start buying up stocks like crazy. By 2009, this pile of cash had reduced to only $24 billion, which is half of what it had been in 2007. Buffett is showing a great deal of patience, which is a great quality to have. Like Buffett, be prepared to let your cash pile build up until a great deal comes along. Next is practice diligence and patience. Like all investment strategies, you must have the patience and diligence to stick with your investment philosophy. Some stocks you might want to buy because the fundamentals are sound, but you'll have to wait if it's overpriced. You'll want to buy the stock that is most attractively priced at the moment, and if no stocks meet your criteria, you'll have to sit and wait and let your cash sit idle until an opportunity arises. Next is dollar cost averaging. One of the best strategies to remain calm and stay invested during periods of volatility is to treat investment contributions like a recurring subscription, a technique known as dollar cost averaging. Through this approach, you invest a specific dollar amount at regular intervals, say once or twice a month, rather than trying to time the market. In doing so, you're buying in at various prices that, in theory, average out over time. This is also an excellent strategy for first-time investors looking to enter the market during times of uncertainty. So how exactly do you start dollar cost averaging into a market? A common strategy is to pair this with stock funds, such as exchange-traded funds. ETFs bundle many different stocks together, letting you get exposure to all of them through a single investment. To dollar cost average, you should set up automatic monthly, weekly, or bi-weekly investments into an ETF through your online brokerage account or retirement account. Through this approach, you would achieve the benefits of dollar cost averaging and diversification, all through a hands-off strategy designed for building long-term wealth. So, to sum it up, if you're asking yourself if now is a good time to buy stocks, advisors say the answer is simple. No matter what's happening in the markets, yes, as long as you're planning to invest for the long term, are starting with small amounts invested through dollar cost averaging, and you're investing in highly diversified mutual funds and ETFs. And last but not least, don't follow the herd. Sometimes, people invest irrationally based on psychological biases rather than market fundamentals. When a specific stock's price is rising or when the overall market is rising, they buy. They see that if they had invested 12 weeks ago, they could have earned 15% by now. They develop a fear of missing out. Value investors like Buffett possess many characteristics of contrarians. They don't follow the herd. Not only do they reject the efficient market hypothesis, but when everyone else is buying, they're often selling or standing back. When everyone else is selling, they're buying or holding. You shouldn't buy trendy stocks because they're typically overpriced. Instead, invest in companies that aren't household names if the financials check out. Also, take a second look at stocks that are household names when these stocks' prices have plummeted. Believing such companies can recover from setbacks if their fundamentals remain strong and their products and services still have quality. Like Buffett, you should only care about buying a stock's intrinsic value. Think about buying a stock for what it actually is, a percentage of ownership in a company. Think about owning companies that you know have sound principles and sound financials, regardless of what everyone else is saying or doing. The stock market now seems to be reviving and inching towards promising times ahead. This means that you can look at pooling in your investment with an aim to gain profits in the future. It is an important financial decision that should be taken with a calm mind. Overall, that is how Warren Buffett invests when stocks are overpriced. Like Buffett, you should always remember that the stock market is a device to convert money from an impatient individual to a patient investor. If you enjoyed this video, consider subscribing to our channel for more. Thanks for watching, and we'll see you on the next one.